So I'm sure you've already heard all about it. Supposedly the stock market is going to crash, the economy is going into a recession because of inflation, and the Fed supposedly having to tighten much more than currently anticipated. All of this stuff. Fear, uncertainty, and doubt, no matter what news outlet you read, no matter who you listen to on social media, this seems to be common consensus, that this is 100% going to happen and that you should sell all of your stocks. But today I'm going to pick apart this argument that supposedly rate hikes are bad for the stock market, because if we dive into the actual facts and real data, according to history, whenever rates are raised, it actually tends to be a pretty prosperous time for the stock market. And it's pretty sad. Some of the biggest stock market influencers on social media are feeding their audience flat out false information about what to expect in 2022 from the stock market. This is either because their research is just terrible, they haven't done any research, or they're just lying to themselves and the audience to fit their own confirmation bias of why the stock market is supposedly going to crash. But here on this YouTube channel, I don't cut corners, and like I said, I'm going to be breaking down this argument using facts and real data and showing you why we should not be in fear and why we should not be selling our stocks right now to no end. In fact, history would tell us we should actually be buying the most stocks right now. So with all of this said, it's been amazing seeing my YouTube channel grow over the past month or so, and it makes me happy seeing all these new subscribers roll in, and it makes me happy seeing all the new names in the comment section. So first of all, if you guys are new here or returning and not yet subscribed, I would greatly appreciate you hitting that subscribe button. It makes me happy, and if you want to make me happy, just go ahead and do it. But with that, I don't want to waste any more of your time. Let's go ahead and get into the facts and data and come to our own conclusion about what we can reasonably expect in 2022 from the stock market. So first of all, there's this flat out false information being spread out there in the stock market community that interest rates going up is going to be bad for stocks and that stocks are going to fall. But we can look at data going back 60 plus years and up to the current time and see that most commonly, the stock market actually goes up as interest rates are raised. For simplicity's sake, I'm just going to be showing a chart that shows data from December of 1990 up until December of 2014. So obviously this is omitting any data previous to 1990, but I can tell you that the trend is the same that is shown on this chart today. Also, this doesn't show the most recent information from the most recent rate hike cycle that took place between 2015 and 2018. Just to give you some quick information, since this chart doesn't show that most recent cycle, basically interest rates were raised 250 basis points or 2.5%, and during that time span, the S&P 500 went up 28%. But now if we draw our attention to this historical data shown on this chart, we can see that between December 2012 and December of 2013, the S&P 500 went up over 40% during a time where interest rates were going up. And between 2003 and 2006, the S&P 500 went up 37.5% when interest rates were going up. And then if we go back even further, from late 1997 until early 1999, the S&P 500 returned 29% in a time period where interest rates were going up. And we can actually see when we break down these four cycles that are shown in this chart in particular, that the average monthly return from the S&P 500 is actually greater when interest rates are going up than they are when interest rates are going down. To be specific, in the 4 periods of rising rates, the average monthly return was 1.26%, compared with just an average return of 0.73% for periods where rates were declining. So this is point number one. Despite what you're hearing in all of these different news outlets or from stock market influencers out there on social media, facts and real data simply don't back up what they're saying, that rate hikes are bad for the stock market. In fact, it actually appears that they are beneficial to the stock market. Next, I actually found this statistic to be pretty interesting as well, where on average, the S&P 500 sees a 13.2% return in the 12 months following peak inflation since 1951, according to data from the Luthold Group. The index saw a 1-year decline in only 3 out of the last 13 instances. In all 3 of those years, 1957, 2000, and 2008 came just before recessions. So this here is even more data and more facts that the stock market is likely not going to crash even lower than it already has. In fact, this is data saying that more times than not, the stock market is actually going to return above average return in the 12 months following peak inflation. And this data, these facts date back to 1951. I would say over 95% of people believe that the peak of inflation is either behind us already or it is coming up in just the next couple of months. And if we follow this data, follow these facts, it would appear that from here going into the future, stocks are likely going to outperform. For example, if we look at the most recent inflation data, which happens to be December of 2021 compared to December of 2020, we had about 7% inflation year over year. But if we get a number in January, for example, of even 6.9% year over year compared to January of 2021, that would mean that all of a sudden, at least in the short term, it would appear that December's inflation number of 7% was the peak. It doesn't necessarily mean that inflation is just going to go away and be non-existent. It just means that we're going to see decreased inflation as time goes on. I think that most economists agree with this thesis. So you may be wondering now, why does this happen? Interest rates going up means that money costs more for companies. It also means that consumers are likely going to decrease their spending, which hurts businesses as well. So why do stocks perform better when interest rates rise? Well, see, people forget that the stock market is very efficient. It is always actively pricing in almost every single scenario possible. In this case, the markets have known for quite a while now that it was extremely likely that raised rates would have to happen at some point in time. So the stock market actively prices that in, actively prices in rate hikes. It also just so happens that every reaction in the stock market is an overreaction, basically meaning that the stock market, whenever it's down, is pricing in some pretty bad stuff. And if anything bad, but not as bad as what's anticipated happens, it actually results in the stock market going up because it's better than the stock market anticipated. And this is kind of funny because this is exactly what's happening now. People are in fear and they're selling everything because they're fearful of rate hikes. And this in turn is naturally pricing in a bunch of rate hikes in 2022. Well, guess what happens if inflation comes down naturally or it's not as high as anticipated? So the Fed doesn't have to raise rates 6 or 7 times, which some people believe is going to happen. Well, even if the Fed still raises rates 5 or 6 times instead of 6 or 7 times, the stock market's likely going to go up because the stock market anticipated 6 to 7 rate hikes. So when we look at the real data and the real facts, history is telling us that right now is perhaps the best buying opportunity for stocks. This is not a time where you should be selling everything. And honestly, I'm kind of confused by a lot of these financial influencers here on social media that are just selling everything. And they're forgetting all of their principles that they have taught themselves and that they have preached to their audience and the people that follow them. To buy when there's maximum fear, uncertainty, and doubt. To buy the dip. To be greedy when others are fearful. All of that stuff seems to have gone to the wayside for one reason or another. But here on this YouTube channel, I don't abandon my philosophies. I don't abandon what's been proven to work. I don't preach something that I don't actively live out. So let me give you some examples of what I'm talking about here. If we take October of 2002, when the S&P 500 was at a low, according to this historical chart, do you think investors were ecstatic about the current economy and what the future looked like for the stock market in this time period? I would argue not, and you can go back and read articles from this time period and see this exact thing. It just so happens that when the market hits its bottom, it's when there's maximum fear. It's when there's maximum uncertainty. It's when there's maximum doubt. And that in the end turns out to be the best buying opportunity. I guarantee you, most people were in tremendous fear like they are now in October of 2002. Then in February of 2009, the financial crisis, the housing bubble popped. Do you think people were ecstatic and excited about the economy and what was to come? Do you think people were excited to buy houses during this time period? Do you think people were excited to buy public companies in general in February of 2009? Absolutely not. If you go back to that time period, you'll see that that was when there was maximum fear, uncertainty, and doubt. And just recently we can look at, and I'll change the chart so we can see this easier, we can look at the COVID crash of 2020. In March of 2020, think back. Everybody watching this video is familiar with this time period. In March of 2020, were people ecstatic about the global economy? Were people ecstatic about the revenues and profits of companies and what they would bring in the future? No, most people were selling the heck out and getting out of Dodge because the global economy shut down and there was quite literally nothing positive to look to. But this, in the end, turned out to be the best buying opportunity. And the people that bought in March or April or even early May made a lot of money by the end of 2020. So as I'm sitting here now, and I realize that the drawback in the markets is nowhere near as extreme as it was in the tech bubble or the housing bubble or even the recent COVID crash. But right now, what I see in the markets is maximum fear, uncertainty, and doubt. You have some of the biggest financial influencers talking about recession, the stock market crashing, all these things and how they're selling all of their stocks because of it. Well, guess what? Not once in history has the stock market done what the majority of people thought it would do, other than one situation. And that is a situation where investors have looked at history and said that if I buy and hold good companies that I believe in, they will inevitably go up over time as long as the global economy stays strong and the United States does not falter. That is the one thing that has been proven to be true in any situation. The tech bubble, people were talking about overvaluations, and things were overvalued. Don't get me wrong. But lots of stock prices since then have recovered. The housing bubble, when that popped, things have recovered since then. Even if you bought at the top of the housing bubble, you're still in the green today because things bounce back over time. The long term always wins, which is why I consider myself a long-term investor with hopes for short-term gains. All these people starting to dabble in these short-term investments, short-term gambles, I should call them, to hopefully get back all this money they lost in 2021 are ultimately, more than likely, sadly, going to just lose everything and lose more money than they've already lost. It's important to remember that long-term investing always wins. This has been the case since the stock market was founded. This is the one thing that has remained true through all of this madness, through all this fear, uncertainty, and doubt. Rarely is there a time where you should be selling everything because you think something's going to happen. And what's going to happen is people that have sold out are going to have this confirmation bias, where after stocks start recovering, they'll say, oh, it's got to go back down. It's inevitable. There's no way stocks can go up. It's going to come back down, and then the stock market will keep going up. And then all of a sudden, they're screwed. The stock market has already gone up 20 to 30%, and they're forced to buy back in 20 to 30% higher, effectively losing just as much money as they were hoping to save. But anyways, I'm going to end this video here. Thank you guys so much for tuning in. Leave a like down below if you enjoyed this type of content. Also, if you guys are new here or returning and not yet subscribed, I would greatly appreciate hitting that subscribe button down below. With that, I hope you have a great rest of your day. Peace out.